Right now, something very strange is happening in the financial world. A war is escalating, oil routes are under pressure, global tensions are rising, and yet gold and silver are falling. Normally, during times like this, precious metals surge because investors rush to safety. But this time, the opposite is happening. Gold has dropped sharply and silver has taken an even harder hit. Many people are blaming the war, the markets, or manipulation. But the real reason is hiding in plain sight. It's the US dollar. And one specific number on the dollar chart may decide what happens next. Over the past few days, investors have been confused and frustrated. Normally, when geopolitical conflict intensifies, precious metals rally because people seek safety. Gold and silver historically act as protection during uncertainty. But this time, the markets are behaving differently. Gold recently dropped significantly, falling hundreds of dollars in a short period of time. Silver experienced an even more dramatic decline, losing a large percentage of its value within days. This has left many investors asking the same question: why are metals falling during a war? The answer begins with the US dollar. Gold is priced globally in dollars. That means whenever the dollar strengthens, it takes fewer dollars to buy the same ounce of gold. The value of gold itself may not actually be weakening. The measuring currency is simply becoming stronger. Recently, the dollar index surged quickly. Even a small percentage increase in the dollar can have a huge impact on metals. Because gold and silver markets are leveraged, a relatively small move in currency strength can cause large swings in metal prices. This dynamic becomes even stronger with silver. Silver tends to amplify market movements. When gold falls, silver often falls more dramatically. When gold rises, silver usually rises faster as well. At the same time, global investors are rushing into the dollar for safety. Even though gold is known as a safe haven asset, the dollar still dominates the global financial system. International trade, debt settlements, and energy markets all operate primarily in dollars. During crises, the demand for dollars increases automatically. This surge in demand strengthens the dollar further, which in turn pressures gold and silver prices downward. Another factor adding pressure is inflation and interest rate expectations. Rising oil prices increase inflation risks, which makes central banks more cautious about cutting interest rates. Higher interest rates tend to support a stronger dollar, which again weighs on precious metals. So the problem is not simply war or market panic. The real issue is a powerful combination of currency strength, economic policy, and global financial flows, all pushing the dollar upward at the same time. But here's where the situation becomes far more interesting. Despite falling prices on the charts, the physical gold market is telling a completely different story. In many parts of the world, demand for real metal is increasing, not decreasing. Premiums are rising, supply chains are tightening, and buyers are stepping in aggressively. This creates a strange disconnect. On one side, you have the paper market, where gold and silver prices are determined through financial trading. On the other side, you have the physical market, where real metal is bought and sold by investors, central banks, and jewelry manufacturers. When these two markets move in opposite directions, it usually signals that something bigger is developing underneath the surface. There are also several powerful forces now shaping the global economy simultaneously. A military conflict has disrupted key shipping routes and increased uncertainty in energy markets. Rising oil prices are feeding inflation fears around the world. Trade policies and tariffs are adding additional pressure to global supply chains. Central banks are being forced into difficult decisions about interest rates. All of these forces are interacting at the same time. Some of them push gold higher, others push the dollar higher. When both forces collide, the result is volatility, sudden swings in both directions that confuse most investors. But the most important factor right now may be a single level on the dollar index. If the dollar continues rising toward that level and breaks above it, metals could face even more pressure in the short term. However, if the dollar fails to break that level and starts falling instead, the entire situation could reverse very quickly. That's why understanding the relationship between the dollar and precious metals is critical right now, because once this tension resolves, the move that follows could be extremely powerful. To really understand what is happening right now in the gold and silver markets, you have to step back and look at the bigger system that controls global finance. Because the truth is, gold and silver are not moving in isolation. They are reacting to something much larger. That larger force is the US dollar. The global financial system runs on dollars. Most international trade is settled in dollars. Oil is priced in dollars. Government debts around the world are often denominated in dollars. Corporations borrow in dollars. Banks settle transactions in dollars. In other words, the dollar is not just a currency used by one country. It is the central operating system of the entire global economy. Because of that, whenever a global crisis begins, something very predictable happens. Investors around the world rush toward safety. But the first place they often go is not gold. The first place they go is the dollar. This surprises a lot of people. Gold has been known as a safe haven asset for thousands of years. During wars, recessions, and financial instability, investors typically buy gold to protect their wealth, and historically, that pattern has held true. But there's another layer to the modern financial system. Banks, corporations, and governments have obligations that must be paid in dollars. They have debts, contracts, and trade payments that require dollar liquidity. When uncertainty rises, they begin gathering dollars to make sure they can meet those obligations. That creates an automatic demand for the US dollar. And when demand for the dollar rises quickly, the value of the dollar rises with it. This is where the pressure on gold begins. Gold is priced internationally in US dollars. That means every gold chart you see is showing the value of gold measured against the strength of the dollar. When the dollar becomes stronger, it takes fewer dollars to buy the same amount of gold. So even if gold itself has not changed in value, the price expressed in dollars can still fall. Think of it like measuring something with a ruler. Imagine you are measuring the height of a building. Yesterday you used a ruler that measured in inches. Today you use a ruler that measures in centimeters. The number you see will change, even though the building itself has not changed at all. That is essentially what happens when the dollar strengthens. Gold is the building, the dollar is the ruler. When the ruler changes, the measurement changes. And that is exactly what has been happening recently. The dollar has been strengthening rapidly, and that strength has pushed gold prices lower on paper charts. Silver reacts even more dramatically. Silver has always been a more volatile metal than gold. It has both monetary demand and industrial demand. It is used in electronics, solar panels, and manufacturing, while also acting as a store of value. Because of this dual role, silver tends to move faster than gold in both directions. When gold rises, silver often rises more, but when gold falls, silver can fall much harder. This amplification effect is one of the reasons silver can experience dramatic price swings over short periods of time. But currency strength is not the only factor influencing the markets right now. Economic conditions are also playing a major role. When inflation expectations rise, central banks face a difficult decision. Lower interest rates can stimulate economic growth, but they can also make inflation worse. Higher interest rates can slow inflation, but they can also put pressure on the economy. Right now, policymakers are trying to balance those risks. If inflation remains elevated, central banks may keep interest rates higher for longer than investors expected. Higher interest rates tend to support a stronger currency because investors want the higher yields those currencies offer. That again pushes the dollar higher. And when the dollar rises, gold and silver often feel the pressure. Geopolitical tensions also add complexity to the situation. Conflicts can disrupt global trade routes, increase energy prices, and create uncertainty across financial markets. These disruptions can affect shipping, commodities, and global supply chains. Sometimes these events push gold higher because investors seek safety. Other times, they strengthen the dollar because global financial institutions rush toward liquidity. When both forces happen at the same time, markets become extremely volatile. But there is another layer to the story that many people overlook. The physical gold market does not always move the same way as the paper trading market. Gold traded on financial exchanges is often represented by futures contracts and financial instruments rather than physical metal. These markets can move quickly because they involve large amounts of leverage and speculative trading. Physical gold, however, is bought by individuals, jewelers, central banks, and long-term investors. In many parts of the world, gold is purchased in local currencies rather than dollars. If a local currency weakens against the dollar, the price of gold in that currency may remain stable or even rise, even while dollar charts show a decline. This creates a disconnect. On financial charts, gold may appear to be falling sharply, but in other currencies, the price may not be dropping nearly as much. That difference can confuse investors who only follow the dollar chart. Another factor influencing precious metals is supply chains. Gold and silver move through global trade networks before reaching major markets. Mining regions, refining centers, transportation routes, and trading hubs all play a role in delivering physical metal to buyers. When those supply chains are disrupted, the physical market can tighten quickly. Even if prices appear weak on financial charts, shortages in the physical market can create strong demand underneath the surface. All of these forces, currency strength, economic policy, global conflict, and physical supply, are interacting at the same time. That is why the current market feels so confusing. Gold and silver are being pulled in multiple directions at once. Some forces are pushing prices higher, others are pushing them lower. And until one side clearly overpowers the other, volatility will likely remain a major feature of the market. But beneath the noise, one thing remains clear. The dollar's movement is currently the dominant force shaping the direction of precious metals. Now let's get to the most important part of this entire situation, the moment where everything connects. Because once you understand this piece, the recent chaos in gold and silver prices starts to make sense. Right now, the entire market is focused on one critical level, and that level sits on the US dollar index. That number is 100. At the moment the dollar is trading very close to that level, It may not sound like a big deal, but in financial markets, certain numbers act like psychological walls. Traders, hedge funds, banks, and algorithms all watch the same levels. When price approaches one of those levels, the market often reacts very aggressively. The 100 level on the dollar index is one of those walls. It has acted as resistance multiple times in the past. Every time the dollar approached it, the rally slowed down or reversed. But the more times a level gets tested, the weaker it can become. Eventually, the market either rejects it again or breaks straight through it. And those two outcomes create two very different futures for gold and silver. Let's talk about the first possibility. If the dollar reaches 100 and fails to break above it, that rejection could signal the end of the current dollar rally. When currencies reverse after a strong run, the move in the opposite direction can happen very quickly. If the dollar begins to fall from 100 back toward the mid-90s, the pressure that has been pushing gold and silver down suddenly disappears. At the same time, all of the underlying demand that has been building quietly in the background starts to matter again. Physical demand from Asia, central bank purchases, long-term investors looking for protection, and supply disruptions would all begin pushing prices higher. Gold could recover quickly because the market has been compressed under dollar strength for weeks. When pressure builds like that, the release often comes in a powerful burst. Silver could move even faster. Silver historically reacts with much larger percentage moves than gold. When the environment turns positive for metals, silver tends to accelerate the move. This is why silver rallies often look explosive compared to gold. That is the first scenario. But there's also a second scenario, and it is the one many traders are watching very carefully. What if the dollar does not stop at 100? If the dollar breaks above that level with strong momentum, it would signal that the current rally still has more room to run. The next resistance levels on the chart sit several points higher. That may not sound like a huge move, but even a small increase in the dollar index can create significant pressure for metals. As we have already seen, a few percentage points of dollar strength can translate into much larger declines in silver and noticeable declines in gold. In that situation, metals could continue experiencing short-term weakness, even if the long-term fundamentals remain strong. This is what makes the current moment so important. The market is essentially standing at a crossroads. On one side, a dollar rejection could ignite a powerful rebound in precious metals. On the other side, a dollar breakout could extend the pressure and push prices lower before the next major rally begins. Either way, the tension building in the system suggests that a large move is coming. Financial markets often behave like compressed springs. Pressure builds quietly beneath the surface while prices move sideways or drift slowly in one direction. Eventually, that pressure releases all at once. When it does, the move can be dramatic. And right now, that spring appears to be tightly compressed around the 100 level on the dollar index. That is why traders, investors, and analysts around the world are watching that number so closely. Because whichever direction the dollar moves next may determine the next major chapter for gold and silver. Now, I want to hear from you, because moments like this are where different perspectives matter the most. Right now, the market is sitting at a very critical point. The dollar is approaching a level that could decide the short-term direction for gold and silver. Some investors believe the dollar rally is almost finished. Others think it still has more strength left. So, the big question is simple. What do you think happens next? Do you believe the dollar will break above 100 and continue climbing, putting more pressure on gold and silver in the short term? Or do you think the dollar will get rejected at that level, triggering a strong rebound in precious metals? There are strong arguments on both sides. Rising global uncertainty, inflation concerns, and physical demand for metals could support higher gold prices. But at the same time, a strong dollar and high interest rates can keep pressure on metals for longer than many people expect. That is why understanding the bigger picture matters so much. If you follow gold, silver, currencies, or global markets, share your thoughts. What indicators are you watching right now? Is it inflation data, central bank policy, the dollar index, or something else entirely? Drop your opinion in the comments and explain your reasoning. The best insights often come from people who are studying the markets closely from different angles. Your perspective might help someone else see something they missed. Before we end, let's return to the one number that ties this entire story together. The level that could decide what happens next in the gold and silver markets. That number is 100 on the dollar index. Right now, the dollar is sitting just below it, slowly moving closer. To most people, it might look like just another number on a chart. But to traders, investors, and institutions around the world, it represents a critical turning point. If the dollar reaches 100 and fails to break through, the entire market could shift very quickly. The pressure that has been pushing gold and silver down for weeks could suddenly disappear. When that happens, the rebound in precious metals can be fast and aggressive because so much demand has been waiting on the sidelines. But the other possibility is just as important. If the dollar breaks above 100 with strong momentum, the rally could continue, and that would likely create more short-term pressure for gold and silver before the next major move higher begins. That is why this moment matters so much. Markets often move quietly before a major shift happens. Prices drift, volatility increases, and investors feel uncertain about what comes next. Then suddenly the market chooses a direction. The move becomes obvious only after it has already started. Right now we are sitting in that quiet moment before the decision. So keep your eyes on the dollar, because the next big move in gold and silver may start the moment that level finally breaks or rejects.